I'm Dr. Cheryl Dunn, and this video is a continuation of the flip and rod bond payable problem. And so this video assumes that you already watched the first flip and rod video on calculating bond prices, or that you are already comfortable with how to calculate bond prices. So if you're not already comfortable with that, you may want to go back and watch that video first before continuing with this one. Recall that in that problem, we were given a bond issuance of $420,000. So Flip and Rod is selling these bonds that total $420,000 out in the bond marketplace. These bonds bear a 6% annual interest rate, which we calculated then the semi-annual interest rate equivalent, which was 3%, because there are two semi-annual periods in each year. So we divide the interest rate annually in half to get the semi-annual rate. We also determined that the 10 years equated to 20 semi-annual periods, and that the interest payment amounts that would be made every 6 months were $12,600. That led us then, in the three different scenarios, to calculate the bond prices with their discounts and or premiums. So the first case that we're given is the case where the market interest rate was 8%, which of course is 4% semi-annually, and that resulted in an issue price of $362,922. The entry that we made when that happened is we debited cash for that amount, $362,922. We credited bonds payable for $420,000 because we will have to pay that full amount back when the bonds are matured. And the difference we called a discount on bonds payable, and that was for $57,078. In this problem, what we're doing is we are calculating the amounts that we need and making the first three interest expense journal entries for this bond. Then we'll look at the situation where the market is demanding 6%, the same as the bond is yielding. And we'll look at the case where the market is only demanding 4% when the bond is paying 6%. But first we'll look at this situation where we had a discount on the bond payable. And we're going to calculate the interest expense for the first interest payment period. So we'll say it's at n equals 1, so after 6 months have passed. And interest expense is calculated as the market interest rate times the carrying value of a bond. In this case, then, we would take the market rate of 4%, and we would multiply it by the initial price of this bond. The carrying value of a bond equals the face value of the bond minus any discount or plus any premium. In this case, the carrying value starts out at the $362,922. If we multiply those across, then we get that first period's interest expense amount as $14,517. The journal entry we would make to record that interest expense, then, we would debit interest expense for that amount, but we would only have to pay, and therefore we would only credit cash for the actual interest payment amount, which is $12,600. The difference then will be the amortization of this discount. So the discount, notice it started out with a debit balance of of $57,078. Now we're going to credit that for the difference between $14,517 and $12,600, which is $1,917. And so that's going to be a credit to the discount on bond payable account. When we then post that entry here, that's going to give us a remaining balance in our discount after this is done of $55,161. That means that our carrying value, get a running list of our carrying values here as well. So at n equals 0, before any interest payment periods had passed, we had a carrying value of $362,922. After the first interest payment period was done, our carrying value, it increases toward the face value, and it's going to increase by the amount by which we amortize that discount, because the carrying value, remember, is the face value of the bond, which is the $420,000, minus the balance of our discount. And so $420,000 minus $55,161 is going to give us $364,839. That carrying value then is what we use to get the next interest expense. So for the second period, once the second 6-month period is over, we're going to take the carrying value at the beginning of that time, which was the $364,839, and we're going to multiply that by the semi-annual market interest rate of 4%, and that's going to give us $14,594. That amount is our interest expense for that second period, so we're going to debit interest expense for $14,594. We're still going to be paying the contract amount that was stated on the face of our bond of $12,600. The difference then of $1,994 is going to be credited to that discount on bond payable. Once that entry gets posted to the discount account, that will then leave us with a balance of $53,167. That will then leave us with a carrying value of $420,000 minus the $53,167. So at the end of the second interest payment period, our carrying value will now be $366,833. Again, that's $420,000 minus $53,167. For our third interest payment made then, we're going to start with that carrying value, $366,833. We're going to multiply that times the semi-annual market interest rate of 0.04, and that's going to give us a total of $14,673. That's going to be our debit to interest expense. We're still going to credit cash for the amount that we pay every time based on the face of our bond certificates. And the difference is going to be credited to the discount on bond payable. And in this case, the difference is going to be $2,073. Once that $2,073 gets posted to our discount account, that's going to leave us with a remaining balance of $51,094. And if we subtract the $51,094 from our face value, that's going to leave us a carrying value of $368,906. Notice that the carrying value is gradually increasing. It started out at the issue price. It will eventually end up, once we get all the way to n equals 20, it will have risen all the way up to its face value. And then when we pay off the bond, we would simply then debit bonds payable and credit cash for that $420,000. The discount will have been fully amortized by then. Okay, so that's our first part. That's what our entries would be and the amounts we would calculate when the bond was issued at a discount. Now, what if the bond was issued when the market rate was the same as the face rate? So part B. With part B, the bond was issued at $420,000 because of the market rate and the face rate being the same. And so we didn't have any discount or any premium, so there's nothing to amortize over the bond's life. Our interest payment entries then would simply debit interest expense for the agreed on $12,600, and they will credit cash for that same amount. And we would simply make that entry every time we make an interest payment. That would be the entry we would make. The carrying value of the bond would stay at $420,000. There is no discount, there is no premium, so the carrying value starts out at $420,000. It ends up at $420,000. So there's no calculating that we need to do. It's already all been done. We would simply make that journal entry in each of the 3 different time periods. Let's move on then to letter C, where in case C, the market rate was 4%, which is a semi-annual rate of 2%. And when that happened, the bond was sold for a price of $488,675. That meant we had a $68,675 premium that now needs to be amortized over the term of this bond. Now our interest expense calculation will be the same as what we saw before. We'll take the market rate times the carrying value in each of the different time periods. Let's go ahead and set up a T account for our premium, just like we did with our discount. And we'll set up a little space for us to do our carrying values down here. Just so I leave myself enough room to do all that. When a bond issues at a premium, it's because we were paying a higher interest rate than what the market was demanding. And that means that our interest payments would be overstating the actual interest expense of the company. Basically, the bond holders gave this company, Flip and Rod, a refund of the interest, the excess interest, up front. But we don't want to recognize that as a decrease in interest expense all at once, so we spread it out over the life of the bond. And that's what we're going to be doing with each interest payment that's made. We'll be taking a little piece of this premium and using it to reduce the interest expense below what the interest payment is. So for the first period, we're going to take the carrying value of this bond, $488,675, and we're going to multiply it by the market interest rate of 0.02. That's going to give us the interest expense of $9,774. However, we'll still be paying the cash that is required by the face of our bond of $12,600. The difference then is going to be debited to the premium on bond payable. And so that's going to be $2,826. So the premium would have started out with a credit balance because a premium is an adjunct liability. It adds to the liability amount. So it started out with a credit balance, and then we debit it for $2,826. Once that entry is posted, then we would have a balance in the premium account of $65,849. The face value of the bond, this $420,000, plus the premium equals the carrying value. So we started out with a carrying value equal to the issue price, $488,675. After that first interest payment is made, we then have amortized part of that premium, and so $420,000 plus the $65,849 gives us our revised carrying value as $485,849. For the second interest payment period then, we're going to calculate our interest expense as that $485,849 times 2%, the market semi-annual rate, and that's going to give us $9,717. We still have to pay cash in the amount of $12,600 according to the face of our bond. The difference then is going to get debited to the premium on bond payable, and that amount is going to be $2,883. We would then post that debit of $2,883 to the premium, and that would give us a new balance in the premium of $62,966. The carrying value of the bond then is the $420,000 face value plus the premium, so we would now be at $482,966. For the third interest payment period then, we take that $482,966 and we multiply that times the semi-annual market interest rate of 2%. That's going to give us our interest expense, which is $9,659. We have to pay the cash of $12,600. The difference is going to be debited to that premium account, and that amount is $2,941. Once we post that debit of $2,941 to the premium account, it will then have a balance of $60,025. $60,025 plus our face value of $420,000 gives us $480,025 as our ending carrying value at the end of period 3. Again, we could continue this example on out, and eventually when we reach n equals 20, our carrying value will have reached its face value. So notice when we start out with a premium, we're moving down. The carrying value decreases each period until it eventually equals the face value. When we had a discount, on the other hand, we started out lower than the face value, so each period the carrying value increases toward the face value. We always start out at the issue price as the initial carrying value, and then we move toward the face value. That's going to be true whether it's issued at a discount or issued at a premium. Okay, thank you for viewing this demonstration. I hope you found it useful for helping you understand how to account for discounts and premiums over the life of a bond payable.